Hello, everyone, and welcome to our Yardi Matrix Multifamily Market Update on November 8th, 2018. My name is Megan Furr, your producer for today's program. We are here today in our Denver studios, joined by our host Jack Kern and our directors Chris Nebenzahl, Justin Dean, and Jeff Muth. During today's broadcast, we will comment on the economy and its impact on investing, managing, and developing properties across the country. Our program will run about an hour and a half, and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation since we will cover many topics that affect your strategies. Please feel free to submit questions in the comment section on your screen during the program, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Now to begin, let's cover the basics. We will be sharing our viewpoint with you on a lot of levels, and what we discuss may or may not be relevant to your situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now I am pleased to welcome Jack Kern, Director of Research, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Thanks, Megan, and thanks everybody for joining us. A little word on the logistics as we kind of get going here. We always start with the answer first, and we will do that again. We have a whole section on technologies, particularly AI and Internet of Things, which we'll cover after we've covered questions. If there's time, of course, that also will be included with the slides, so nobody will miss out. You can always give me a call if there's any questions on it. Some really cool stuff in there. All right, so let's get into it. So what's different from the last time we spoke back in May? I think really bottom line, demand was better than we expected, and that really kind of buoyed things in terms of rent growth and occupancy. Overall, economic growth was better, and so we're in a better place as we go into the fourth quarter than we thought we might be when we started this. So quick, 2 seconds on the impact of the elections. I think right now the budgets will get more contentious, more drawn out. The debt ceilings will be a lot of drama. So that's, in my view, from an economic standpoint, that's the only thing that really happens. There's not going to be much legislation passed unless sort of lightning strikes. So, kind of things kind of keep rolling, generally speaking. The opportunity zones, I think, we have, because it's in the tax code, we'll have time to sort of work and come to fruition. And a real positive in that Prop 10 in California failed, and failed convincingly, 62-38, no. Which I think buys the industry overall some time to provide some free market solutions around affordability, some topics which we will cover today. All right, so kind of now let's go into the details here. The economy is in very good shape. Not to say there are not some headwinds, okay? Employment is up, growth is humming, greater than 3, 4.2, 3.5 in the last quarters. I think given the headwinds, I think it's more in a 3-ish number or 3.2, 3.3. It's not going to accelerate from here because of some of these headwinds on trade and immigration. That appears to be sort of like, again, providing sufficient headwinds not to provide acceleration. Plus, you have interest rate movement on the low end. The 10 years come up 20 basis points to 3.2. So all that says that you're going to have some slowish. It's not a slow down, but a leveling out of the rate of growth. Oil prices have been bouncing from 60 to 70, kind of come down from 70 since we last spoke, in the 60 range. Still high enough that we can make a pile of money as a domestic industry. And even though I would think that with the Iranian withdrawal of supply from Iran, global growth actually is weakening a bit in Europe and in China. So that, again, we're sort of the stronger one among the group, and with our interest rates going in, we're going to continue to draw in capital. Wages, the recent print, 3.1%. The labor market is really tight. Then was it Alan Greenspan says the tightest labor market he's seen in 50 years. I think that's very accurate. None of us have an experience of a labor market this tight. Inflation's rising, not likely to break out to beyond 2.5%, but we'll continue to look. The 10 years in the range of 3 to 3.2. I think it probably moves 25 basis points every, quarter, 6 months. The big thing to watch, we're going to watch the yield curve. And paradoxically, while the real estate industry doesn't like the 10-year moving up because it makes, it clips values, for the economy overall. It also gives room for the short-term rates to move up without inverting the yield curve. The multifamily market, it faces increasing crosswinds is probably the appropriate term. Demand is strong. It is shifting to lower cost cities, but we did see some of the tech cities like Austin, like even Northern California, which had been, we were worried about, it actually kind of moved up quite nicely. The home ownership rate is gradually rising, but as we've seen, the increase in mortgage rates did actually slow down home sales. So there's, again, a bit of a positive for multifamily. Financing costs are up. This is about finding situations where NOI outstrips the change in interest rate costs as transmitted, into values. There's a lot of capital, both debt and equity. There's no shortage of capital we put to work because demand is resilient. I think if we look at across asset classes, industrial and multifamily are the favorite asset classes among all the food groups. The new supply really is weighting down several markets, but it is getting absorbed. And the level of new supply is flattening. I think we're going to see this 300,000 units kind of level quite a while. So it's in pretty good shape. Tech hubs, yeah.
Hey, Jeff, do you think homeownership will still continue to rise even with home price sales or home prices rising?
Our models indicate we had put in about 10 basis points a year of homeownership increase purely on demographics, just people wanting to own a home. If interest rates move higher, it may be a little slower than that, you know what I mean? But I still think demographically people are going to want and do want to own homes. It's now a question of affordability. If the homeownership rate doesn't rise, then that demand will flop over to single-family rentals. But I think the movement in life stage, will keep in the same way. It's going to transmit it to more space because of purely aging of that millennial group. Okay. So tech hubs are emerging in formerly non-tech metros and overlooked cities. The cost advantage of emerging tech hubs is already shifting the geography of jobs. And again, the longer this goes on, the greater the critical mass it becomes. Tax reform is already seen as accelerating these trends. And as an investor, you have multiple points of entry. We'll discuss that as well. The point I would say, last year, this time, we really focused on energy and autonomous vehicles. And we kind of kicked the can down the road on Internet of Things and AI. In this section, we have that material. I've covered it in some other discussions I've had. And it is when you put all those together, it basically says long-term, short term, it's going to be a sharpshooter's game. And in fact, transformation industries and extraction industries are going to do better. When you look at all the technologies that are coming, you're sort of driven back to be, I want to be where the force of ideas are happening. Those ideas are being created in more and more places, in more and more cities, but the same basic drama kind of plays out. Intellectual capital nodes in more and more of the cities that have lower cost structures and are creating the environment for new jobs and of creative talent to happen. So what's our 2019 outlook? GDP and employment will continue to grow a little bit of a slower pace, we think, in the back end of the year, so that our overall forecast for rent growth is in a 2.8 to 3 range, formerly 2.8. Multifamily supply is still kind of clipping up. There's a lot of projects that are being sort of warehoused into the perspective. They're not getting done. They're not moving because financing and cost of construction are too high. So they're not getting done, but they're being kind of set up for eventual, once those conditions change, to be built. There is an interesting dynamic happening in co-living and co-working, and I would kind of say that in terms of the changing demographics and responses to costs. And so overall, in my view, over the next 2 years until we think there's a recession, 2.5 years, it's really a sharpshooter's game. You got to find particular situations that are particularly appropriate. I don't think there is a little bit of a rising tide here, but values are high too. So I think it's a very kind of sharpshooter's game. Okay, so let's kind of go forward. Economic growth is pretty good. The third quarter was up 3.5%. The GDP now, which we follow, is running 2.9, 3, which definitely shows a bit of a slowdown. I mean, there's no question about that, but still really good. So I'm not really kind of worried about that. If we kind of look at, I always kind of break this apart between population growth, which isn't growing, labor force participation, which overall had a good print, 0.2%. And if you look underneath those numbers, the greatest jumps were young people without educations, right? So folks who had been out of the labor force are being drawn in at the bottom end of that labor force, which is great. And we see productivity and hours worked up where we're getting that 3.5% kind of move in overall economic growth, or GDP growth. Wage pressures are increasing, right? You've got, again, with labor force participation going up, the employment rate is still 3.7, historic low. Wages picked up from a 2.6 to 3.1. And as we've kind of mentioned before, if you unpack the wage growth, right, and say there are folks who are beginning to retire or reducing their participation in the labor force, and that masks actually a stronger wage growth for people entering the labor force than is in the official numbers. Good for not forcing the hand of the Fed too much, but also good for people who are now acquiring income and also can rent and form households. The labor market is crazy tight. So October's job formation was great. We now have more jobs than people. And if you look inside, millennials are a force for that expansion. We now have another generation just beginning to enter the labor force. And the older generation, the boomers, are not leaving necessarily at the same rate. So that's how the overall labor force is continuing to grow. And this is kind of this notion of the reserve supply of labor. There's still enough gas in the tank to keep this thing going. The lack of immigration, right, has forced companies, not because they want to, because they have to pull people off the sidelines who are detached from the labor force or loosely attached to it, and it is moving wage rates up, particularly at the bottom end of the scale. And so we actually kind of put some data here for office-using industries. You can see there's a shortage of labor, right? So that number below 1 means there are more jobs than people. And even in other non-office-using industries, it's either below 1 or right at it. And so again, across the economy, you've got a labor shortage. For our industry, you look inside, we also cover the office sector, of course. And so office-using sectors are actually growing slightly faster than non-office-using sectors, and incomes are growing faster for our office-using sectors than non-office-using sectors, which, again, these are higher-paid jobs and a higher rate of increase, which means if you look at total dollars that can be deployed to higher-level rents, it's still kind of hanging together. Again, to the point where it's gotten out of hand, these jobs shift to other cities, also in intellectual capital nodes who have the same sort of lifestyle and concentration of live, work, play environments that create a great place to live and work. Inflation is going up, and you kind of see this where services are kind of coming down a bit and materials are kind of coming up a bit. This is a bit of an impact from tariffs and a shift of economic growth from consumers to producers. Which is a big shift because since 1980, it's been exactly the opposite. So this is a little bit of a rebalancing and consistent with the administration's constituencies. Implied inflation, we look at the 10-year and the TIPS, it's muted 2.1. That's not kind of crazy. Inflation is moving up, but it's not sharp. It's not kind of sharp. If you look at compared to the last economic expansion, it's kind of a slow grind. Oil prices were rising. They're kind of, I think that today's it was $61 a barrel, so it's been bouncing around a lot. Between 60 and 80, you're going to see a trading range. I don't think we have to worry about that. I mean, this industry has survived at $40 a barrel, so at 60, it's kind of printing money. The big advantage we now have as an oil producer is that the other countries, the OPEC countries, have to look at their budget balance. We don't, so because it's a private sector industry. So I think we're in a much better shape. One thing I covered, and this relates to some of the things we do in technology, is at the back, is when you look at the disposition of people inside the oil industry, right, in a contraction, and in 14 and 15, what you see is that the people involved in the field is flat, right, and came down a lot. Now the people involved in support activities have come up, but not nearly to the same extent. So the mix is more towards support, which is high tech, but the actual numbers is actually significantly lower. So this industry is much more efficient, not because it wanted to, because it had no choice in order to survive, which is again kind of the benefits of a free market economy. We'll cover that we'll cover that dynamic in other industries. So if you look at the economy, it really is in high gear. Despite a correction, it's still up decently. International bond yields in the lower right are higher than everybody else, so we're the tallest midget if you want to ask for that. But the bottom line is at 3%, we're going to attract capital, and the 10-year being with 3.2, the breaking past 3 is meaningful. I don't want to say that it is meaningful, but it seems to be sort of a slow drift upward. So we're in pretty decent shape. The yield curve bears watching because this is, in my view, the chief vulnerability. So we actually look at 5 models. Ed Hyman at Evercore does a great job. He's one of the best economists on Wall Street, and he looks at these 5 models historically about where you look for recession risk. And right now, I would say the 5th one is the one that is the binding constraint, which is the yield curve. It's not yet inverted, but it's been dancing it's been flattened and dancing with an inversion. So when you look at this historically, the Fed funds rate and really the inversion of that yield curve is where we're saying, we think we're 2.5, 3 years out, in terms of a potential recession. Yes.
Jeff, some people are of the opinion that corporate debt could trigger the next recession. How does devaluation of corporate debt reverberate through CRE capital markets, and what would it do to asset values?
Yeah, if you think about that, what you're really saying is, would you get in a situation where a sector is over-levered, goes bankrupt, and fires a lot of people who then don't have an income to work, right? And would it be a big enough blowout to affect the economy overall? It's kind of hard to see where that is, right? I mean, yes, you may have the junk bond market, Jack, I don't think is really kind of freaked out, right? Not so much. So the spreads aren't that high. People can get capital. There's profitability is decent. The tax bills are lower. So now you've got kind of a boost to cash flow, right, to even service that. If you were to have a blowout, I would say it would be in the sort of early stage tech companies, because some of these are valuations and they're burning cash. And at some point, if they don't turn, someone's going to wake up and say, hey, why am I investing in WeWork and it's burning cash like crazy? Let's dump it. So I think there are places where there's companies that are over-levered, but I don't yet see it so systemic that it would cause things to sort of crater. So I don't really see that as a significant vulnerability, but we're going to be watching for pockets, right? We've done some other earlier webinars where we kind of looked at where are the pockets where we would see, corporate debt go kind of be overextended, and it would be in the tech sector and in the healthcare sector is where I would be looking for it. But I don't see it significant enough to sort of cause a recession. But again, you get that inversion of the yield curve and bank debt and everybody kind of pulls back. The places that are the most overextended, the places where they're going to be vulnerable, and that would be in the tech center. It would be in early stage tech companies, right? There's a lot of tech companies that are spinning cash like crazy. They're not going to have a problem. Make sense?
Yes.
Okay. All right. So talking about yield curves, there is actually some debate about which yield curve to use. We happen to use the U.S. 10-year versus the overnight rate. And this is the one that we look at closely. But if you look at the other yield curves that are being used, they kind of tell you about the same story, that it's sort of flattened but not yet inverted. So here's the 10-year versus the 3-month, flattened but not yet inverted. There's the 10-year versus the 2, which is the one that you could argue is in the danger zone. But even the Fed has said they would prefer that we look at the 10 versus the 3-month. We use the 10 versus the overnight. I want to go back to a second. I've actually had a couple folks put together composites of the global yield curve, right? And again, it kind of says roughly the same thing, since global capital markets are linked. So again, there's a flattening, but there's not yet a inversion. So this is now a bit of a balancing and dance between short-term and long-term rates. The Fed holds the short-term, the market holds the long-term. But still, I think, still there, but definitely a yellow sign worth looking at. But in the meantime, you make hay while the sun shines, as one of my former bosses told me. Now, if you look at federal policy mix, it is mildly pro-growth, And it, though not fully articulated, I can sort of tease out that it really is about shifting growth from consumers towards producers. So you look at the pro-growth elements that we've talked. This slide has been the same slide I've had for now for 2 years, since November 2016. Tax reform, regulatory relief, and executive orders are a tailwind. Immigration control and trade negotiations are headwinds to overall economic growth, but they are designed to balance and change the nature of who gets that economic growth. And it turns to be more toward producers, which happen to be located in places where land is cheaper, where you're mining stuff or manufacturing stuff, and you need lots of space to do that stuff. Land's got to be cheaper, it's less densely populated, so this ends up being a rural versus urban reshifting, which also happens to be consistent with the administration's main constituencies. And then there's a bunch of stuff in the middle that no one's doing anything about. Yes. Oh, Megan, you got any questions?
Oh, yeah, no, we just want to say thank you for calling in today to our fall 2018 multifamily market update.
Cool, thanks. So what? The bottom line is there's enough growth in there, so guess what? Capital still needs to be put to work. Now the question is, how do you do that? All right, so let's go to the next. So demand's really not a problem, so your attention turns to supply. And if you look at overall supply, 300,000 units, give or take a couple here or there. Some of the stuff has been extended due to construction delays. Some of it's been delayed because of construction costs. But the bottom line is we think there's 300,000 units. It's going to be finished up for the next several years. There's enough bank capacity, lending capacity to do that. Not too much. And I've been actually helping a bunch of lenders. And it was funny that they were looking at, should I put my money into a secondary central business district that's sort of like struggling, or should I put the same money into a multifamily property, okay, that's in a secondary multifamily market on the fringe of so they were both secondary, and if you look at the fundamentals, I put the money in the multifamily all day long. So, and this is, banks who are allocating the capital as well. Where should I lend? So when I kind of look at that, and with other clients that I've looked at on development deals, it all seems to look like, yeah, there will be new supply, about 300,000 units. It is going to be shifting, right? I think investors who are institutional investors are going to keep kind of playing in downtowns because they know that area, and there's enough demographic demand on both ends of the age spectrum to keep that busy. And then folks who are not quite as institutionally invested, don't have access to that lower cost of capital, are going to be developing in the secondary markets and intellectual capital, secondary and tertiary cities. So I don't see that happening, and Megan is furiously raising her hand. Yes.
Do you think we will see increased attention on remodeling older properties?
Look, the value add strategy is one of those sort of almost can't miss, because basically you're producing, an improved quality of asset underneath the price umbrella of new construction. Okay, so it's not a question now, and there's ample demand for it. It's more the economic and the return. There's a lot of work to do a value add. Right? It's a tremendous amount of work, and when you look at the actual, the cost of that, remember the material costs are going up. The actual acquisition cost of the underlying asset ain't cheap. So it's hard to make the deal work. So again, you're looking for special situations, particular situations where you actually are getting paid for the work you have to do. It is not easy to do. I've done them. There's a lot of work to it. So I think it's still there. It's a very valid investment strategy. There's a lot of people who know how to do it very well. But it's not going to be easy to find. Jeff?
Markets where it's occurred a lot, markets where not so much.
Pick any market in the top 40 and it's been done. I mean, the real issue is everybody has been basically recycling through these assets, and the question is, well, what's left on the bone, right? How much meat is there on the bone here? And so anything that has been updated in the last 10, 15 years is sort of, now you're looking at, you could be doing redevs on 04 and 05 assets. Easily, right? Easily. Which most of us scratch our head. We were doing redevs on 80s and 90s assets, right? So it's to get your idea that you should be redeving a 2003, 2004 asset is a little bit like cognitive dissonance, but I think it's still the right move. There's also, if you can find a busted A deal, right, that isn't leasing up well, that's also great too. But I don't think there's a lot of those to be found either. Okay, so I'm gonna keep moving here. So the bottom line is, Construction is just catching up to household formation, and the builders have been focusing on higher priced single-family homes because they can. And if you look at this on multifamily, rent growth bounced back, occupancy bounced back. So this is a strengthening of conditions that we saw over the summer. But the fact of the matter is, as we all know, and I think we don't really kind of realize it, that there was a time when a lot of the new construction was affordable to median income households. That's just not the case anymore due to the cost of construction and land costs and zoning and permitting. This is the sort of, the anomaly. If you look at since 1970, the CPI and rent really tracked quite evenly, right? And here you have this sort of since 2010, since the recovery, it's literally off the charts. There is no historical comparison to the level of real rent growth that's been achieved in this recovery. And it looks, demographically, you got a very big tailwind that we do think it is tamping down, right? It's not, you're not getting 5-6% rent growth sustained nationally. It's down to 3%, which is 1% over, say, inflation. It's about equal now to wage growth. That's, yes, there are certain cities that are at the 6s. There's also cities with the 2s. But overall, it's kind of falling back in line going forward. But that pop hasn't changed and transmitted into these sort of income to rent ratios, which we kind of follow. And if you look at this, all of them, except Pittsburgh, are less affordable than they were before. But to a greater, and so what you see is when things get totally bent out of whack, people go to places that it's more affordable. And you can see here on the right-hand chart is that what's the gap? It's quite significant between rents in a very high-cost city and rents that are not. And so you do see a sorting. We're even beginning to see out-migration from Denver to folks down to Colorado Springs and other places because folks who were settled at a certain mental number and income level with the rise, they're having to go other places at a lower cost. So we're seeing a sorting of this, and this is kind of moving along significantly. Yes.
How much longer can we see rent increases continue when increases in salaries are not keeping pace?
Well, if you look at this, let's go back here, right? On average, with the exception of a couple of cities where it's 42 or 40%, the income to rent ratios are about 33%. I mean, certainly that's everybody's criteria loaded into their systems, right? Which means that you could, if wages are going up 2-3%, you could afford up to 5-6% in rent. Now, it would be happy because all your money is going to rent, but it's conceivable. So to say, you're going to get a 3% increase in rents or a 4% increase in rents, giving wages going up at 2-3%, that's sustainable. There's nothing out of whack about that in terms of dollars. Right? You have to convert the dollars of wage increase to dollars of rent increase. Okay, so when you do that, there's nothing inconsistent with a 3.5% increase in rents. And if you compound that puppy, you got a pretty decent IRR on a total hold. So I think it's entirely sustainable. So let's go. Values rose in the summer, and they've kind of leveled off here. I think this is a reflection of kind of interest rates going up and a retrading of asset values. And we did a number of models about 2 years ago, where we basically, using some of our expert data on expenses and building NOIs, came to the conclusion that, for every 25-30 basis point increase in the 10-year, if it was fully transmitted, you would need something like a 4% NOI increase to offset it. And guess what? NOIs are increasing about 4 or 5%. And so what's happening is a leveling. If interest rates can move, it's really the pace of interest rate movement and NOI movement. There has been some compression of debt yields, and so some of that has been absorbed, but we expect this kind of phenomenon to play itself out. Now, there are policy responses to affordability. Now, there's a command and control orientation, which was Costa-Hawkins, or appeal of that Hawkins and exclusionary zoning, and then there's market-oriented approaches, where people are trying to say, okay, if it's really expensive in urban areas, what can I do to change the nature of the utilization of space to improve affordability? And so we're going to cover a few of those. But there is a lot of activity here. Co-living, Airbnb, streamlined zoning, Freddie Mac changing its kind of some of those requirement of loans, some HUD policy changes. There's a lot of ferment in construction and trying to create a production facility in construction, as well as the opportunity zones, all the market-oriented approaches. Yeah, is there a question?
Oh, yes. Going back to the sales price index.
Yeah.
The sales price per unit index, is it inflated by new construction being a large part of what trades?
Actually, it's not. Most of the trades are in the middle of the pack. So if you look at the ratio of the total inventory to the ratio of kind of like the orientation of the spreads, well, if you look at total dollars, but we actually kind of look at this in terms of on a normalized transaction basis, mostly it's Class B apartments that are trading in it. So I don't think it's a major impact at all. When we look at, there's a couple of, this happens to be an NIDO, which is really an Airbnb model. It happens to be working in an Orlando facility near, obviously near a lot of big tourist area. So the thing here that's a little bit different is that everybody knows when you're renting in this particular apartment community that everyone has the opportunity for Airbnb usage of your defraying your rental costs by being in an Airbnb kind of in a situation. So you don't have that problem of renter disconnect. Okay. It seems to be going okay. We don't really know exactly how hard it's going to spread, but it would seem to fit with places that are high tourist destination or high urban areas. So it was started in Orlando. I think I know. Speaking to these guys, they're going to try to do it in some more urban areas and see if they can make it work. There's another model called Domio, which is really group travel. They put up a deal in New Orleans. So that's another kind of model trying to take this down. One thing that I find really interesting is I'll call it rent by the bedroom. It's and ex-social property management groups out of Chicago have a couple of deals with this. There's other players like Common where they're taking, in this case, ex-social has said, I'm going to take a third of my units and I'm going to make them in essentially, he doesn't want to say this, but it's graduate student housing. Okay, you get a bedroom and a bathroom, and you share the common areas, and your costs come down. Okay, it's because you're sharing that space, and so the models that they've had is that you could probably take out, from $1,800 to $1,200 from a studio down to one of these shared spaces. That's $600-700 a month. That's a meaningful chunk, and for people who don't have the need for privacy of common area space, not a bad trade to get into an urban kind of environment. Now, Common is another interesting kind of play on this, and this particular play is that what they've looked at is they looked at the cost and said, wait a minute, the real cost is the kitchens and the bathrooms. So if I want to get my profits up and my costs down and shrink the square footage in half, which is what they've done per person, then you got to share a bathroom. And so that their model is like a 5-person, kind of suite with 3 bathrooms and a common kitchen. And their play is, well, we'll cover the cost of maid service and we'll cover the stocking the bathrooms in order to get the cost down. So it's another interesting model. They're trying to ramp up as well. All of these are really small initially, but the idea is one that I think has some legs in urban downtowns for entry-level, living spaces. Co-working is another one of these other plays that is essentially similar of what happens when you have very expensive space and you're trying to sort of jam yourself in there and lower the entry point. Though, this started as a sort of freelancer kind of world, the money in co-working is really curating a tech experience for larger companies. That's where they're all making their money. And now I'll call it the freelancer is kind of a loss leader, to be honest with you. And there are a couple of big players. We track this segment, and we're in a big way, both analytically and from providing services to these players to power those spaces. Also, it is a big deal among landlords who are saying, why should I have the downside risk and not take the upside benefit? And they're actually going into, taking 2 to 3% of their space and creating a co-working experience. So that's kind of interesting. Yeah.
In a downturn, Jeff, do you think more tech firms will go into the co-working space rather than signing a traditional lease?
The biggest ones are taking down buildings and signing long-term leases, but they've got a lot of cash flow. No, I think the co-working experience I think it's mostly about how do you attract very creative, talented talent into companies that the culture doesn't fit that way, or how do you incubate, kind of middle level companies. So I think it's got a place, but as a landlord, the part that I'd worry about is we worked at a great job setting up every single lease as a separate LLC. Their explicit strategy is during a downturn to put a bunch back to the landlords, consolidate their space into sort of their stronger locations. So again, they put all the risk on the landlord. Smart for them, a little tough for the landlord, and only if the landlord's getting a benefit. Again, we're drifting off the office a little bit here, but because of a WeWork branded building, gets them something for their longer term leases. It's the equivalent of corporate housing and multifamily, it was great, sounded great in the upside, and then the downturn is horrible. So, and where's the curve and where places are tightest. So again, markets work. Okay, so let's shift it a little bit. And one of the things we want to take a look at was, these evolving trends in emerging tech hubs. And it was really prompted, it started from a Amazon 20 kind of exercise that we decided to expand on a little bit, right? Like, let's look at this more. So in the blue are the markets that were in the Amazon 20, and then we added to that. So we look at the basic ones with the gateway cities, and then some known tech hubs that are so reasonably well established, and then some tech hubs that are emerging, that are, I'll call it dark horses. A couple of them showed up in the Amazon 20, and we added a bunch more. So if you think about this kind of view, the first thing we kind of looked at was, well, if you look at compound annual growth rates of the values, it looked like the gateway cities had a the longer the run happened, and then we look at this from 1990 on, you actually end up at the same place in terms of compound annual growth rate. But in a downturn, the gateway cities did a bit better. So it says in the secondary market, you definitely want to have a capital structure that doesn't put yourself exposed during and get a liquidity crunch. But in terms of rents, again, depending upon the time frame you're looking at, the secondary markets have kind of caught up. And so, again, it's interesting. It ends up in the same place. But obviously, the entry point for secondary asset secondary is really a big city was actually lower. And as you see this now, sales have shifted to secondary and tertiary markets. It's in our own data here. We kind of see this pretty clearly. And that means because when you're looking for what's the next thing, you're looking for where employment is continuing to grow and where that has a cost advantage, and that is occurring in these secondary and tertiary cities. So when you look at this, we looked at kind of job growth. Where's job growth happening? And there's a little bit, we updated this data for 2018 versus kind of last year. And you see Phoenix, Orlando, Las Vegas, Reno kind of dropped down some, Raleigh, Dallas. These are areas that, these are, I'll call it well-established tech hubs that are growing very rapidly in jobs. And then you look at where the jobs are growing in the larger markets. Boston actually is the sort of, the best of the bunch among the gateway cities, but growth is a lot slower. Now, yes, it's off a bigger base. I get that, but from a percentage basis, it's quite a bit slower, and you can see this in terms of where jobs are moving and how companies have begun shifting labor forces. Schwab, KPMG, even Salesforce are examples of explicit decisions of established tech companies, established financial service firms, right, who are moving jobs, not the lowest end jobs, not the highest end jobs, kind of jobs right there in the middle of their talent stack to other places. Population growth also kind of going in secondary markets. Secondary is really gateway, established cities, and tertiary. I feel bad about this notion of that Dallas is a secondary city. It's not. It's a big area. Yeah, it's a big city, big metro area. So it's a bit of a misnomer. I think tax reform will accelerate these migration patterns. We've already seen it. I think it's going to be accelerating. There's nothing which says that there's a reason for it not to. And if you look at states that spend and tax less, have higher growth rates. Just the nature of it. And this you see this kind of drawn out here in these stats. Immigration has been it is a key to the gateway cities' population growth. And there is, if you look at on the left, you have cities that have both annual domestic migration and some level of international immigration. International immigration being sort of much more restrained, right? in Orlando, I think, benefits from both the Puerto Rican movement as well as domestic migration. So you got two sources of tailwinds, and in the gateway cities, you're having more domestic migration than domestic outmigration than international immigration inward. And if you've made a bet on these primary cities, you're basically making a bet on international immigration, okay, or you're making an acknowledgement of the bifurcation, right? At the very high end, it's good. At the very low end, but you're hollowing out the middle. Megan, you got an announcement?
Yes, I just want to thank everyone again for calling in today to our Fall 2018 Multifamily Market Update.
Right. So this is some work that Issy Roman did at BuildZoom, which really says that it's kind of an acknowledgement of that very high cost international gateway cities are somewhat, I use the word a casino economy, which is talented people come, they bring their chips with them, and they basically try to play, and if they hit it, and they made it, and if they get to their 30s or 40s and they've acquired obligations and they can't make a go of it, guess what? They go to another city that is lower cost. And so we see this sorting of populations between cities, and this is an interesting analysis, which is, and we're trying to understand like what was behind Amazon's thought process, right? And so if you look at exceptional talent and very high labor costs, the Bay Area and Seattle are kind of up there. And then when you say you move, it's not a surprise here that the ones that were in the Amazon 20 are very high labor quality at slightly lower cost, right? Not lowest cost, slightly, and then the dark horses were good and lower cost. But so we began looking at all of these cities and what we could learn from those in terms of tech cities. So again, this was more a notion of where Amazon was going, okay? But if you look at where the overall drift is, you can kind of see that there's a lot of these cities that are having emerging tech capital nodes. And this is just another way of expressing that a little more easily to read. But if you look at the timeline for how it takes to develop a tech center, we used Austin's example, it takes a while. So that also means, in terms of as an investor, you have multiple entry points. Now, I do think that the cycle time, as in many things, is compressing for newer cities because they can look back on the history of how you do it, and there is a playbook. But I think that also for investors, you have decisions to make about when you want to enter a tech hub and at what point of risk and return you want to play. And there's some cities such as Phoenix, which is fundamentally changing its character. Now, if you asked me 20 years or 15 years ago, Phoenix was largely call center labor, right? It was inexpensive overflow labor from Southern California. But it is now acquiring intellectual capital nodes, which is changing the nature of the city. The same thing is happening in Orlando, where the nature of that city is fundamentally changing. And the knock on both Phoenix and Orlando was highly cyclical markets, right? High swings, high ups, high downs, and generally you could get occupancy, but you couldn't get rent growth. And I think that's fundamentally changing in those cities. We really sort of, I would say, not we've invented, but more sort of expressed a model really built by the former mayor of Pittsburgh, who currently works for ULI on a consulting basis, about what does it take to create an intellectual capital zone? What are the components of that? And we've kind of done this and for about 40 top cities, and clients can get access to the whole work we've done here. But this is an example of Columbus, where we just kind of said, well, here's Columbus. How does it play on each one of these components? And what's happening in Columbus that's driving it, right? And I could compare this to Syracuse, New York, or Buffalo, New York, or Wilmington, Delaware, and you can see there is a substantial difference between how these cities play out and what they're doing civically. And the playbook's there. It's no longer a secret, but you actually have to work the playbook. And then we also have some information on specifically what's happening in Columbus, and it's a bit of a Midwestern success story. And there are other Midwestern success stories as well that are trying to leverage their lower cost position and create the environment in a holistic way that becomes a self-fulfilling kind of a positive cycle. As we kind of move this, I think was this September numbers, right? So we actually just now have October numbers, that are about to get released. And the interesting thing on the October numbers was that most of the markets strengthened on a year-over-year basis. A couple of exceptions. Boston kind of ticked back a little bit. Tampa ticked back a little bit. Charlotte ticked back a little bit. Chicago ticked back a little bit. But most of the other markets actually strengthened, which is kind of an interesting kind of development going into October. Now, on a sequential basis, rents were flat, but the year-over-year basis, actually, rent growth actually went up. And as we kind of look forward, so one of the things that I always ticked me when I was on the other side of this conversation was people would sort of put out forecasts at the beginning of the year, and then they would conveniently forget what their forecast was when they give you the next year's forecast. So what we want to do is, have a little bit of accountability here and lay out, this is what we thought going into the year, and here's what's actually happened. And from that, like, what was different, and what are we trying to learn from that? Right? And so what you kind of see is, in a number of places, Orlando and Las Vegas and Tampa were significantly stronger than we thought. A lot of markets we kind of got right or close to right. And a couple, we missed, I think Sacramento slowed more than we thought it would. LA actually, here's the other part, LA has actually accelerated back up to 4.3 in October. So I think LA may kind of get closer to what our forecasted growth was. Austin turned out to be stronger, I think, because absorption was stronger than we thought. Seattle actually was weaker than we thought because of new supply being a greater impact. And Dallas ended up being stronger, but weaker than we thought. But we actually see Dallas picking back up. So, I think all in all, I feel pretty good about what we've done. But where there's timing differences, we're trying to learn from that and holding ourselves accountable to you and to ourselves for the accuracy of our forecasts.
We have a very sophisticated forecasting model, and it's going to be too hard to go over it today on this call, but we would be happy to share it with you and talk more about it at some point if there's something in particular you'd like to know.
Yeah, and then Jack and his team lead the forecasting effort, which are far smarter bunch of guys than I am. But if we kind of look forward, we expected a bit of a bumpy 18 to 24 months. It's actually a bit better than we thought. There is a spread among markets when we look at, the ones that are higher growth and have potential supply problems. That's happening in Salt Lake and Denver and Charlotte and Seattle. Yeah.
One of the questions that we always get is, we want to expand our portfolio.
Yeah.
We want to grow. What do we do? Where do we go? How do we use this information?
Well, I think where you think about it is, where am I now? And what are the next bunch of cities, right? So if let's say I'm Los Angeles based, or my portfolio is Los Angeles based. Well, the first thing to take a look at is, what is the markets closest to you that have the characteristics of emerging tech hubs? It might be Eastern LA, it might be the Inland Empire, right? So the first thing you want to do is stay a little bit close to home, and then the next one is, what's the next band? Right? It's really hard if I'm an owner to say, I'm going to go from LA to Charlotte. That's tough. That's really tough, because you're really changing the nature of what you're doing. So I think more appropriate is to start radiating around your home base, and then eventually you do become national as you've radiated over time outside of your home base. And so you use this data to say, what are the cities that are benefiting? Again, if I'm starting from a gateway city, what are the cities that are benefiting from overflow, from job growth, from intellectual capital in the area that I'm most familiar with? Or if you're starting in Dallas, you'd say, okay, which parts of Dallas and which cities around Dallas, right, are the ones that are, that's a logical way of approaching it. It's not logical for you to go, again, if you don't have a national footprint already. Okay, if you have a national footprint, then you can look across the entire field here and say, which of the markets have the best prospects for growth based upon the growth of these emerging tech and capital hubs, and what's my time frame with my capital, and do I want cash flow, or am I looking for capital appreciation? So the great thing about multifamily real estate, as in all real estate, is there are multiple successful strategies. It's really making sure that you've tied your capital stack, right, to your opportunity. Or if the opportunity requires a lower capital stack, you've gone out and you've sourced that capital that's aligned with your strategy. And so I think that's the biggest issue, is making sure that your strategy and your capital stack are aligned, both in terms of your investment window and your mix between cash flow and capital appreciation. So that's how I would kind of answer that question and kind of play it. We did do some longer range kind of forecasts because I was looking for demand supply balances, and we really kind of came out with, if you look at these cities, right, there are a few cities that appear to be, oversupplied. Now, this analysis did not take into account benefits of migration from the tax law. So when you look at this, you would say, well, Denver's got some headwinds to it, Seattle's got some headwinds, Charlotte's got some headwinds, so does Dallas, so does Phoenix. Now, we haven't seen it in Phoenix, because I think job formation has been better than we had anticipated. But in the other markets, yeah, we've seen some weaknesses, weakness in terms of rent growth. Now, absorption's pretty good. It's not been as bad as we could have been, but this generally kind of aligns with what you're seeing. And again, if you're looking at plus or minus one, I kind of view that as a rounding error. I'm looking for things to tail that kind of inform us, and that's where we kind of pick those things up. And then what is interesting is LA looks like there's a housing shortage, and you are beginning to see, rents move upward. Same in the Inland Empire. Houston, I always have an asterisk because, they'll just build more. Houston's got a good, so it's very hard unless you're in the areas of Houston that are affected by traffic, and so they're really not the same. And Houston really is about nine different cities, not one. You really have to look inside the nodes versus the whole metro area. We also, when we look at sort of rent growth for the next couple of years, we do see, some markets bouncing back up. We do see Salt Lake bouncing back up, Eastern LA bouncing back up relative to kind of the year-to-date numbers. But we also see, some decent size. We see some kind of trail down in Boise and Vegas and Phoenix, more from a question of new supply coming on. But it's still pretty good. It's still real good. And if we look at, kind of these are the bottom ones that I think will be the weakest. We think that are the weakest markets. And guess what? If you're not the top, you're not the bottom. Everybody else is in the middle. Obviously, our clients get access to the whole 133 markets in the 3,500 or 4,000 submarkets. But we think overall you're sitting in a 2.8-ish number. Again, relative to inflation, relative to income growth, it's a good place to be. Again, some markets will outperform for a stretch. Some markets are underperformed for a stretch. But generally speaking, things over time return to the kind of the mean. And I think that's where we're kind of headed. Over the next 5 years, when we did this analysis, we do think that there are still some markets that might have some issues of supply, and it's not surprising. Seattle, Charlotte, and Dallas. And again, the point about Seattle is, in one way, you could say there's some weaknesses, right? On the other side, it was an explicit public policy to have a lot of supply built to enable that economy to move and for it not to become like San Francisco, not for it to become like Northern California, like Silicon Valley. So to the extent that the city governance, the city consensus, it is achieving its consensus, right? You can still build. There's still lots of supply. There is a very vibrant community. There is an ability to continue to grow that. Amazon's view is more that it can't hire 50,000 more people, but it's not to say that there isn't a vibrant tech community. And the bottom line, Seattle has achieved its public policy goals of providing a lot of supply and kind of managing that. Yeah, great, super. All right, so that's, we put these together into the 2 and 5 years. And really, when I step back, this is really a good story. There's a couple markets that appear to be a little bit oversupplied, but if you look across 133 markets, in this case 40 top markets, and all you can come up with is 3 or 4 that could be oversupplied, this is a market that's really quite a good balance. So I'm really not worried about the overall kind of health of the multifamily industry. Yes, being some headwinds. Now we're going to take a break here. I want to make sure we have enough time to answer all the questions. We're almost at the hour mark. So let's take I want to make sure we finish up all the questions we have, and then if there is time, we'll go into these technology areas, which I think is pretty cool. But go ahead.
How will opportunity zones affect multifamily development?
Great question, and there's a lot of both ferment and capital being formed to take advantage of opportunity zones. And as I've looked at the opportunity zones in kind of more detail, what's intriguing about it is if you go look at the maps, I think the areas that will be most likely to succeed are opportunity zones that are adjacent to already well-developed areas. And there are a lot of opportunity zones that are just adjacent to those. And that's where you're really just extending an established market, and now you're using the benefits to sort of make development, feasible. But if you look inside the regs of it, one, you have to have capital gains to roll over. So it's not going to be the traditional source of capital like pension funds. It's going to come out of high net worth families, and they're the ones most interested in it now. You do have to increase your basis by, I think, 100%, 50%. So you have to, but you can exclude land from that basis. So that's a real big help, right? So it's just the building basis that you have to kind of, enhance. So I think if you think about that, there's also rules on holding it and how fast you put it to work, and you got to put it to work in 30 months, and you got to roll it over a certain period of time. It's like a super 1031, okay? And it has to be put into funds, not in particular assets, which is kind of good. And then not all the rules are kind of fully baked, but most of them kind of are emerging. And I think this is going to be most effective for areas where you're making a placemaking. You're changing the place so that the multifamily investment should really be coincident with changes in office, changes in retail, and it is feasible to do so, okay? So I see a lot of mixed use stuff that would be a natural fit. There's also, you don't have to put it into real estate. You could buy a business and invest in that business that happens to be headquartered in that opportunity zone. So there's some flexibility built into this, but I think it will be another opportunity for I think it's primarily new capital that enters the real estate sector, and the ones that are going to be, I think, most successful are adjacent to, existing kind of infrastructure and nodes. Yeah.
Why do we seem to be capped at around 300,000 units a year? Is it zoning, permitting, construction, labor?
I would say a little bit of everything. I think one of the primary drivers is debt capital. So debt capital at a certain cost and leverage. The banking regulators have been pretty consistent since 2015 of saying, look, to the banks being as a major provider of capital for new development, of, hey, guys, don't go crazy. And they have been very clear, and but not too loud, to the banking community, saying, okay, there's a certain amount of capital we're okay with, but don't go nuts, particularly in multifamily, and as they saw rents beginning in new assets to sort of, kind of tamp down and concessions kind of pick up. So I think it would have been 300,000 almost regardless. Now, there are private debt firms that have come in to say, hey, we'll fill out the stack, we'll help you. But that debt is more expensive. It takes equity participation. So the deal has to be really, really good, okay? And now you have rising construction costs and rising permitting costs. Some deals just don't pencil, right? So a lot of the urban core deals just don't work. Katerra and other sort of product construction methodologies are trying to bring in construction costs that will be 30% lower. Some are beginning to work in highest cost locations like California. So there's sort of this movement around, but there's still there's still some natural constraints. Because it's true, we build stuff the same way we built it 130 years ago. So that's kind of nuts, right? But it's very capital intensive. I can tell you, there's a lot of capital being burned to try to change the construction industry. Big upside, a lot of capital involved. That's why I don't think it's had really taken off up until now. So I fundamentally don't see the conditions, leading to a 600,000 unit year. It's just not there. Okay, 300,000, and if you look at the new development pipelines that are there, they are beginning to spread, into other cities, into places where there hadn't been new supply before. So, I think we're about there. Yeah.
Who's renting these high-end apartments? Is it younger people? Is it baby boomers? Are there enough people with high incomes to sustain the development of?
We've been looking at this for quite a number of years, right? And the fact of the matter is that you're getting demand at both ends of the age spectrum. The ones that are filling the highest end units are in fact boomers or folks who didn't get married or didn't have kids, and again, if you look at the demographics, right? If you look at the aging of the millennials, right? They marry later, they had kids later, right? So that whole thing has been extended. And on the other side, boomers have been filling. If you look at uptown Dallas, look at downtown Denver, most of this New supply has been absorbed by people in their late 40s, early 50s. Kids are gone to college. They're healthier. They're going to stay in the labor force longer, and they want to enjoy themselves. And why not do that downtown? And that is definitely happening. Now, understand, because if younger folks do want to live downtown and they haven't yet acquired the income to afford a $2,000 or $3,000 apartment, that's where you're getting the demand for common and for ex-social. Because how do you get the entry point in? So I think it looks pretty good. I mean, we have enough of a population shift and enough of a population movement where it's almost like an all of the above, right? And the suburbs are growing. They're growing around intellectual capital nodes that are a combination of the work-play environments. So again, we still have a growing population, and it is aging. That aging of that population is also in the labor force longer with higher levels of income. Okay, that either can't retire or don't want to retire. A little bit of both. So I think it's sustainable.
If you had $20 million today, what would you buy or build?
Ouch. A tough. So the real question is, well, is it 20 million cash? Is it 20 million of a commitment to investors?
How quick can it get here?
So I think one of the questions you want to ask yourself first, and in order to answer this question appropriately, is what are my cash flow requirements versus my capital appreciation, and what time frame do I want to achieve this under, right? So, if you were saying, hey, I'm really interested in cash flow and a tax advantage cash flow, and real estate is tax advantage because of depreciation, then a Class B asset would be very deep, lots of demand, good job formation. But you're probably going to get 5% gross, right? I mean, if you lever it up, you're going to get 8 to 10, and unless you do a value add, which is really tough, if you're not doing it at scale, you're not going to get mid-teens, right? If you want to be opportunistic, I mean, the opportunistic play would be, can you find a Class A deal that had trouble in its lease up? That would be a great thing to do. You can find them; they are out there. I found a bunch of them, but you've really got to find a needle in a haystack. So those are the ones. And again, Jack was bothering me here about development. Like, would you build? It's the highest return, but the highest risk, right? You're not going to get cash flow for quite a while, but it can make sense to do development. That's why people are still doing it, right? Because their capital stack is consistent with no cash flow and decent capital appreciation in the right place. So I would say, well, it depends, right? As in all things. But those are a couple ideas. Any other questions?
So we've seen millennials driving less, owning cars less. How is this going to affect multifamily design and the opportunity for rent growth if they're not saddled with auto loans and car maintenance?
It's great. Look at the income to rent ratios in San Francisco or New York. Well, you ask yourself, how is that feasible? Well, I don't have 17% of my income going to a car. That's how it's feasible. Okay, that's how you do it. Okay, so if you think about this and you say, again, it's going to play itself over some period of time, right? But if you think about this, to the extent that you could reduce your transportation costs from 17% of income to 8% of income or 5% of income, right? You now have a choice about how do you want to deploy that extra income. Do you want to live closer, right? And so you're sort of bustling and hustling, and that's all great, very vibrant. Do you want to use that to acquire more space, right? Because you have a growing family and you want to be near better schools, you're going to use that income in a different way, okay? I think it's a boost, quite frankly, to single-family rentals because of that. And I think it's also a boost to urbanized environments or urbanized environments in the suburban nodes, which, again, is a theme we've been talking about for a number of years. Bottom line is, it's a really good thing because it frees up income to do other things, and one of those other things is the value of place, which we happen to benefit as an industry. So it's great. Any other questions? Yeah.
If there's a downturn in the next 2 years, which markets do you think will be hurt the most?
Well, the places that are sort of, it has historically been the case that the ones that were last to the party are the ones that got hurt the most, right? Because those were the last jobs created that are less core to the business when things retrench. And I think we see that in the gateway, in those 20-year kind of analyses of gateways and rent. So what it tells you is if you're in a secondary or tertiary market that is experiencing rapid rent growth, you had better get your debt structure in line to absorb a downturn. Because again, over time, it's a great deal. It's just how do you put your debt structure in place that you're not squeezed out during a downturn. And I'd say, oh, by the way, you really need to focus on efficiency, right? So I haven't really discussed here on the expense side, but the fact of the matter is that given the fact that margins, I would say largely speaking, in the multifamily sector, if you're a GP and you've got the returns to your LPs and it's costing more to acquire and put the money out, you've got to be ruthlessly focused on efficiency. And there is a bunch of money to be had by focusing on tools that are readily available for buying better, for managing your advertising spend better, for managing your MRO better. I think the whole thing I'm excited about the Internet of Things is that it also helps drive your maintenance costs down and increase your ability to do preventive maintenance versus maintenance when hot water heaters bust, which are nasty. So I think a ruthless focus right now, not only on sort of operating well from a consumer standpoint, but looking at where can you rip costs out now, right? Because the taxes aren't going to go down, okay? That's not going down. And keeping your people is not going to get easier. We've got a labor shortage, and one of the most vulnerable components in a multifamily community is the maintenance techs, right? Those guys, and they're largely male, but there's many women maintenance techs as well, are hard to find, hard to keep. And so efficiencies, and I think the IoT or automated home allows you to do more with less, and also to pay those people more because you've increased the productivity because they're only focusing on things that the maintenance activity you're on top of. I think that's a huge opportunity that drives your cost down. And we do have seen that you can get revenue for IoT components, mostly around security, not really around convenience. And so there's going to be a consumer-facing part of the IoT for the home, right, and a sort of a back of the house. The back of the house is for the landlord to drive down maintenance costs. The front of the house is going to be for security and control. So that's my long answer to that short question.
What is going to happen to the Class A development deals that are all delivering within such close proximity to each other this late in the cycle? And will equity partners take a haircut, or will they ride this out?
I think that doesn't look to, as long as there's demand, people will ride it out, right? There's just, what you do see is, will you see concessions when you have a sudden wave of supply? Yeah, you do. You are. Yes, you're seeing it, right? So it doesn't surprise me. People have concessions, usually 2 to 4 weeks up front to get people in the door. Not very common that occurs. So it takes a little bit longer. Now, I would tell you that you've got to finish your lease up in a year and do whatever it takes to make sure you're finished leasing up within a year, because you don't want to go into an 18-month lease up where you've got to release plus continue to absorb. So that's the only time pressure I think is relevant. But it's getting absorbed. Maybe not quite at the price you hoped it would be, maybe not quite as fast as you hoped it might be. But when I look at the pre-leasing curves, and I look at a lot of them across different markets, they're generally pretty good. Things are leasing up. Yes, with sometimes not quite the rents you would have hoped for, but they're getting done. In which case, you hold on, you hang on. So I don't. Again, there are a couple where I've seen lease up stall, but in most cases, they've been pretty good, and people hang in there.
So Jeff, we've seen a lot of market-specific questions. So
yeah.
we'll throw a couple more.
Well, one thing I wanted to get to, because someone else brought in a question I thought was just cool. So before we get to the market-specific ones, the question came in about, hey, if you look at Crystal City and the Amazon 2 headquarters, what's going to be the impact on Crystal City, and can it absorb it, and all that kind of good stuff, right? So that actually this came in this morning, and it was like, oh, wow, that's a really cool question. So I began looking at both Long Island City and Crystal City. So Long Island City being kind of the Queens portion of New York. And what does both of these have in common? One, they are adjacent to major metropolitan areas, but they're not inside the core. They're very similar to the Lake Union, downtown Seattle, kind of like approach that Amazon took, so that's kind of consistent. And then I began looking at both of these and saying, well, because one, I didn't look at Dallas there's always enough supply in Dallas. So one of the biggest question I had was, is there enough housing supply in these places to absorb over time these new employees in some way, right? So Dallas, don't worry about Dallas. There's always more supply. So I kind of focused on Crystal City and Long Island City, just looking at those things. And so the interesting part, I'll cover Long Island City first. Crystal City first. So when I looked at it in Crystal City, but you really had to expand beyond Crystal City and look at all of kind of southeast DC. If you put both of those together, it was really the Navy Yard area. You have 76,000 existing units, and that are 96% occupied at average rates of about $2,200 a month. But you have a new supply pipeline of about 35,000, more, quite adequate. And these are ones that are not much in the DC area. 10,000 are under construction, 10,000 are planned, 18,000 are prospective. Right. So the bottom line is, hey, if you saw that kind of demand coming, these would turn into real projects. So that's not bad, right? There's enough supply of housing. Then I actually looked at on the office side, how much square footage is vacant today in Crystal City. There's 700,000 square feet, enough to get them started, right? If they took it all down, if they decide to build their own campus near Anacostia or Southeast Washington, there's a metro line. You can pivot around both ways. So that doesn't look to me that's doable, right? That's totally doable. Then I was to Long Island City, and really, it's more expensive. Average rent's $3,700 versus $2,200. But even there, while there's 43,000, there's 15,000 units that are completed in Long Island City. But the new supply pipeline is 25,000 units that's been identified. Now, again, most of that, if I kind of look at this, is 8,600 units under construction, 33,000 planned, but 15,000 prospective, which means if there was demand, they'd be built, right? So then you look and say, well, there's 25,000 units that could be built there. So I look at either one of those and say that now both look good. So what has this led me to believe is that they're using Dallas as a stalking horse, and they're going to pick both of them. Because there's supply, there's location, they're near sort of high-end talent where they want to be. They're on the East Coast. Jeff Bezos can hang out in his Washington, D.C. Home. He can take the train up to Manhattan. And if you look at what's going on in Manhattan, I mean, just this morning, there was some plans that Google was taking down 1.3 million square feet, right, as it moves out along the 8th Avenue, and on the west side. So there's clearly, demand and supply to absorb this. So I thought that was a pretty cool question, and you didn't. For the person who asked it, thank you. For everybody else, you got an answer, even though he didn't ask.
While we're in New York, what are your thoughts on Brooklyn versus Manhattan or perhaps Queens now?
I think rent growth has been like 2%. I think that's kind of the numbers we pulled, which isn't bad. It's been stable, but you're talking about $4,000 a month rent. So $4,000 a month times 3, you got to earn $12,000 a month. That's at least 100,000. So that you just absorb to take any apartment, you got to have $100,000 income to afford an apartment, not a condo, just an apartment. All right. And if you look at the rent growth, it's 2% overall. Where there's been movement, 2% at the upper end, 16% increase in rents at the bottom, but there's just not that much there. And what in Manhattan, lower workforce, average rents are $2,900. That's the low end. Okay, the high end is $4,600. So you're talking about a whole different world in terms of and again, with the exception of people who can afford that kind, they're probably 2 and 3 doubling up, tripling up to make that work. So I think Manhattan is kind of stasis, kind of like hanging in there. And whether you're going to see, you need some kind of big impetus for Brooklyn or Long Island City to kind of happen. But those are areas that are beginning to grow. There is a lot of supply in Brooklyn, 18,000 units are getting delivered. So it's going to take a little while for that stuff to absorb. Would Amazon help absorb some of that? Yeah, I mean, you could. I haven't looked at the subway line because I think it's a little hard to get from Brooklyn up to Long Island City. It's not that easy to get there, right? It's almost easier to go to Manhattan and come back around, right? Which is kind of weird, but that's the way the transit system's set up. Maybe it'll be buses. And it's not out of the realm of the reasonable for Amazon to basically run buses, right, from all those apartments in Brooklyn up to a Long Island City campus. That's not out of the realm of the reasonable. So, anyway.
Jeff, what global issues might impact multifamily in the short and long term?
Gosh. One, I think, obviously, these technology issues are big. And I have to remember that one of my I forgot that our legal guy said, I need to do that. Was it the disclaimer or the copyright notice? One of them. The copyright? Okay, so I'm supposed to do that. So I'm doing that now. There are so many issues. If you think about what impact, one is a whole set of technology issues that affect. So any way that impacts the way in which people live and work impacts multifamily. And I think Rich Anderson wrote some really good note on this about looking at all of the societal changes, and they do ripple through multifamily. So you can't be a multifamily professional and be devoid of an awareness of the larger societal trends, lifestyle trends moving around you, because you're really locking yourself out of what's happening. So it's a good question. It's a very broad question. So the first thing, obviously, is what's going on with technology and who gets hired, what's the nature of work, what kind of work gets done, and I would say that the home is emerging into a software platform. Okay, that's one of the big kind of takeaways from the IoT kind of analysis, and that AI, one of the big takeaways from that is that the level of knowledge that you have to continue to have to be creating change versus being at the sort of the end of change being delivered to you is increasing. Okay, so that's a thing, and in order for that to sort of like ripple through, it means you really need a great education system to provide, one, employment, and also to provide generational movement to take those kind of jobs. Because I think, it's not crazy to believe in artificial intelligence and robotics eliminating the lowest cost, the lowest skilled activity. So right now, you're getting people who are coming off the sidelines, and so in the short term, it's great if you don't have an education, right? Things are better in the economy. But long term, this stuff, can be automated away with time and patience, and there is time and patience to be had. So it kind of draws you back to what are the communities that have the best education systems, broadly based, not just for the wealthy, who will always find a way to educate the kids, but for the poor. That's sort of the societal issue that I always kind of come back to. We've had that in some of our previous webinars. I haven't included it recently. We had a whole bunch of different sections previously on societal infrastructure. And so I very much, think about societal infrastructure as the power of local economies. Local economies drive multifamily investment, right? The power of local economies do that, and the nature of work. So I really think about education systems really, really deeply as canaries in the coal mine. And quite frankly, we've got a crappy one nationally. And so it's a key societal weakness. our capital markets are a strength, and our rule of law has traditionally been a strength. So that's why we get capital from other places. If you're looking for a haven for capital, where do people come? They come here, right? If they want to sink their money into it, they sink it into real estate. Why? Because it ain't moving. It ain't moving. They can lend, they can borrow on it if they need to. It can be a bond if they don't. And there's a lot of fortress locations that they don't have a long-term downside. I mean, I love the upside, but it's a safe place to park your cash. It happens for the Venezuelans, for the Russians, for the Chinese, you name it, for the Saudis, right? If you're looking to put money away and you still want to get a return, the U.S. is a pretty darn good place to put it. So I think we're the beneficiaries of all of that, and we're the beneficiaries of being the reserve currency. So you want to make sure we're not, it's a great thing to be the reserve currency. So those are the main things to look at. This could be another 3-hour conversation if you had to ripple through all of the potential influences. But you do want to look at technology. You definitely want to look at the way in which people live and work, and making sure that we remain a capital source. And I know we're at 12:20, but we're going to run till 12:30 until we run out of questions.
How best can market rate apartment owners thrive in an environment where rent control is an ongoing threat?
So let's assume for the moment that you're in a market, right, where you have an existing asset, and so we can take the issues of new supply out, right? Well, I looked at places that have already been living through this, okay, and Toronto is a great example of this, right? What you tend to do is focus ruthlessly on costs. You're not going to have a lot of turnover in these environments, right? So you can be very picky on your customers. Very high credit scores, very high stability. So if I'm a player, if I have an existing asset, I'm operating an existing asset in a market that is potentially subject to rent control, I'm going to be very choosy about who are my renters, right? I want to have the lowest cost to serve renters. I want to be very focused on my expenses. I have to really look about my service levels, right? So the fact of the matter is, and it's hard to say, is that in these kinds of environments, customer service levels decline. Why? Because there's not a competitive market that pays you for great customer service. It's sad. It really is sad. But you're drawn, and again, I've worked in Canada and in Toronto, and that's what happened. And what happened was, and people took their capital and they put them somewhere else. Now, the Toronto multifamily families moved them into U.S. real estate. They said, I know multifamily, but I'm generating cash out of Toronto, but I don't want to put the money back in Toronto. So they basically bought U.S. real estate. For U.S. investors, it would be other cities. They take their capital, they invest in other cities. So you basically move your money gradually out of the place where it could be at risk. Because if there is rent control, right, or the threat of rent control, then obviously capital appreciation ain't happening, because your buyer doesn't have a story, right? So it just really is about the cash flow in place, and what's the value of the cash flow in place. That's, I think, the best way to sort of. It ain't a pretty picture, but that's the way the world works.
What is your viewpoint on the interplay between the following factors and their relative impact on valuations over the next 5 years? Inflation versus cap rate movement versus cost of debt versus cost of equity.
So I think it kind of relates back to a comment we had before, which is there's an interplay here between why would long-term rates go up? Okay, long-term rates would go up because economic growth goes up or inflation goes up. All right. Now, the countervailing point is what makes multifamily NOIs go up? Well, there is demand for housing, people have jobs, and their wages are going up, right? So generally speaking, multifamily investment has been a hedge against inflation, so that as your cost of debt goes up, so does your revenues, right? And so as we've kind of mentioned here is, okay, if the cost of debt goes up today, your revenues have to go up, 4% for the values to not have been impacted. Now, one of the great things about nominal debt in an inflationary environment is that it depreciates. So you also have to, again, take a long-term view. As part of your capital appreciation in a semi-inflationary environment will be the implicit depreciation of your of your nominal dollar-denominated debt, which actually basically gives you a little bit of boost to returns, right? Because your debt basically depreciates. Okay. So these are basically, now it's a balancing act. Okay. Now, to the extent that you can reduce your costs and increase your NOI, right, beyond which the market will give you on rent, is another way to sort of manufacture returns. It's not going to be it's not going to be a silver bullet, but it's going to be a nice, to mix metaphors, a nice single. It's not going to be a home run, but it'll get you a single, it'll get you on base. And so that's where I would kind of say, and our basic investment strategy is, why do you have to be a sharpshooter? Is that you have to outrun the increased cost of debt by finding special situations, by finding cost reductions, by finding pockets of very stable customers that don't give rise to cost. Any questions?
A little bit more market specific. How do you feel about Florida, where the economy is so reliant on tourism, and how would this impact the economy of Florida during a downturn?
Well, actually, the economy of Florida is becoming less dependent on tourism than it had been in the past. And quite frankly, one of the things that benefits, right? If you can look at Miami, which has now become, yes, there's some tourism, there's also a sort of services and financial capital. Okay, and Miami has gotten so expensive that basically there's domestic migration outward of Miami toward Orlando and Tampa, which just we see so Miami is one of these cities that really should be considered a gateway city, but isn't traditionally considered one, but it operates like a gateway city in its basic dynamics. So I'm pretty bullish on Florida. You also have a tremendous, because of the way it's structured tax-wise, and look at Orlando in terms of its development of an intellectual capital node. Something's happening there, right? So you're having a diversification of the economy. The Achilles heel of Florida has always been its primary education system, which is not very well funded, and basically you got to pay for, most people of a certain level of affluence won't even consider public school in Florida. So that's the Achilles heel of the societal infrastructure. But the taxes are low. It's a business-friendly environment. It's in very good shape overall as a state. There's still a fair amount of land to build on. It's a big place. So Miami and the Gold Coast there is kind of built out, except for West Palm Beach, which is kind of, rents there are quite high, and it has become its own financial capital. The tech capital is more happening up in Orlando, and Tampa's made a significant investment on $1 billion seaport. Got a seawalk, which is creating that environment, because Tampa doesn't have the sort of heft of an Orlando, which is an interesting interplay of cities, but it's trying real hard. The ugly stepchild, to use a overworn metaphor, is in Jacksonville. Jacksonville has never really had these sort of centers of intellectual capital. It's been a warehouse, it's been a port city. It hasn't really had that. It's been the place that great investment ideas went to die. And so there's a lot of investment going on in Jacksonville, hoping that will change. I think it's still early stage in Jacksonville. Other questions before we sign off? We are running up almost at the hour and a half mark.
Jeff, if we didn't get to any of the market-specific questions, is there a way of contacting you?
Yeah, send me an email. We pulled a lot of the numbers. We just didn't get a chance to get to every single one of them. You can always get back in touch with me. So, kind of wrapping this up. One, thank you so much for devoting an hour and a half of your time for this discussion. We appreciate you and your business. We try to make these things valuable and useful for you. Of course, you're going to get the access to the recording and the slides, even the ones I didn't have a chance to cover. Happy to follow up with you guys over the next couple of weeks. If you have questions, comments, thoughts, ways that we can make this even better. And I hope you found this of value. We had a lot of fun putting it together. And I look forward to talking with all of you and meeting with you over the course of our events over the next couple months. So Thank you very much, and I will have Megan kind of close us out.
Thank you for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to be included in our future programs and subscribe to any of our free research publications, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Chris Nebenzahl, Justin Dean, Jeff Muse, Jack Kern, and Jeff Adler for their contributions to the content in the program today. This has been a production of the Matrix Division of Yardi Systems, copyright 2018, all rights reserved. This concludes our broadcast. Thank you.
Thank you. Have a good day.